behalf of our team at HBKS Wealth Advisors, I would like to welcome you to Managing Your Real Estate Portfolio with Tax Efficiency with HBKS Principal and Senior Financial Advisor Tom Taranto and HBK Principal Ben DiGirolamo. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you would like to submit a question to our panel, please use the question box in the GoToWebinar control bar. Due to the content of this presentation and industry regulations, we are unable to provide attendees with a copy of the materials. If you have any additional questions after the session, please contact us. We value your feedback. Please complete the survey at the end of the session to let us know how we did. If you would like a complimentary financial review, please let us know via the survey or by email. For more information and insights, please visit our website at hbkswealth.com/insights. At this time, I'd like to turn it over to Tom Taranto.
Thank you, Lori. This is Tom Taranto and Ben DiGirolamo. I'm going to take a minute to introduce the firm and introduce Ben and myself. I know a lot of folks on the call are possibly current HBK or HBKS clients, or maybe even both, but I know not everybody is, so I want to take a minute to introduce our firm. HBK CPAs and Consultants was founded in Youngstown, Ohio in 1949. We started as a kind of plain Jane accounting firm doing tax and assurance or audit work, and we've grown exponentially since then. We're one of the top 100 accounting firms in the United States based on size. We're part of the BDO Alliance of Firms, which is a key recognition nationally and really an indication of the comprehensive nature and expertise that we're able to provide. We've grown to 17 offices in Florida, New Jersey, Ohio, and Pennsylvania. And our services have really grown to encompass virtually all financial related offerings: accounting, assurance, risk advisory services, corporate finance, valuation, business coaching, and more. Ben has been with the firm, I guess about 12 years. He's a Pittsburgh native. He's a Pittsburgh sports fan, avid golfer. Ben is on our tax advisory group, or TAG group, which is kind of the central hub of all things tax. Anytime any of our HBK or HBKS professionals need an advanced level of expertise on a tax-related matter, Ben and his group are who we call. So Ben has extensive experience in a lot of industries, not least of which is in real estate. So we appreciate Ben for participating today. Maybe jump back to HBKS there, Lori. So HBKS was established in 2001 with the merger of Hillbarth & King, which is now HBK, and the Sorcy Financial Group out of Erie, Pennsylvania. This was really done for a few reasons. Certainly, we thought as a firm that it made business sense, but it also brought a level of expertise to the wealth management of our clients that the CPA side didn't feel like they could find elsewhere. So I sometimes think of our role at HBKS as trying to match the expertise of the accountants, and we're striving to do that every day. We've grown extensively since 2001. We have almost 100 employees. We have over $5 billion of assets under management, which is really wild for those of us who've been around for a while. We have offices in Florida, New York, Ohio, and Pennsylvania. And we work on all areas of family and business wealth management. So that goes from investment management, financial planning, retirement planning, wealth transfer, We're now rolling out family office services for our wealthiest clients. So we try to be a provider for any need that an HBK client would have. I've been with the firm since January of 2011, so I just celebrated my 10th anniversary with the firm. I work with a variety of clients, but most particularly clients in transition. So that might be a transition to retirement. That might be a client transitioning out of owning a business. It could be a client transitioning via inheritance. So it tends to focus on folks that are going through a transition. And one of those transitions that seems to be happening more and more, and how I've developed, or Ben and I really combined have developed a niche in this real estate world, is folks selling business-related real estate investment properties and how to most efficiently do that. So that's what we're going to talk about today. So we're going to spend the first half of the presentation, roughly maybe a tiny bit more, talking about the 1031 exchange. This is a very important tax concept. It might be a little bit of review for some of you guys, and it might be brand new for others. So central to everything related to managing investment properties and real property is this 1031 process. From there, when Ben wraps that up, I'll cover some of the opportunities that you guys might not be aware of in securitized real estate, or real estate that has an investment wrapped around it, and how that pairs with a 1031. So with that, I will pass it over to Ben to talk the tax side of 1031s.
Great, Tom, thanks so much for the introduction. I wanted to point out, if you notice Tom or I looking over the camera like I just did a couple of times, we're actually sitting across from one another in a conference room here in Canfield, Ohio today. Each have our own cameras, of course, but I'm doing my best to keep my head down and look at Tom through the camera, but he happens to be right across the table for me. So with that, Tom asked me to talk about today are really the basics of a Section 1031 or a like-kind exchange. And I think it was important what he said. It's probably something that some of you have heard of, maybe some of you have done, and maybe it's a brand new topic for others on the call today. So I want to step back and kind of look at the basics of what it is, what the opportunity is, and then how we accomplish this. And so first off, what do I mean by, why are we calling it a 1031 exchange? It's actually part of the Internal Revenue Code. It's Section 1031 or 1031, also often referred to as a like-kind exchange. So those are kind of the two terms we will probably use today. You probably hear them in articles or publications or the news about this planning opportunity that now only exists for real property. And this slide points out that this has been around since 1921. So if I'm doing my math right, that's 100 years that the like-kind exchange has been part of the tax laws in the United States. The bottom bullet point is the actual specific language from the code section as it exists today. And it says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment purposes, if such real property is exchanged solely for property of a like kind, which is to be held for the productive use in a trade or business or for investment. So there's a lot to unpack there, but I want to kind of make this a little bit easier for everybody. The opportunity here that exists under Section 1031 or the like kind exchange is that if I sell real property, and that real property is either used in a trade or business or held for investment, I don't need to recognize the gain for tax purposes if I exchange that property for property of a like kind. In other words, if I acquire more real estate, then I can potentially defer the recognition of that tax gain under the rules of Section 1031. And so what I want to do today is go over that a little bit more, give you some specific examples of how that works. But again, to put a big picture on this, if I own property worth $1 million and I bought that property for $250,000, the $250,000 would be what we call our basis for tax purposes. I paid $250,000, that's my basis. If I was going to sell it today for $1 million, the difference would be a taxed, realized, and recognized gain of $750,000. And I would pay tax on that gain, on the $750,000. In the alternative, if I reinvested that $1 million of cash that I received in that sale of property, I can potentially defer the gain, the $750,000 of gain, and not pay tax on it today. And I use the word defer because that's the way the rule works. I don't eliminate that $750,000 of gain. It just kind of stays with the new property that I acquired or properties that I acquired. And the way that that happens is through the transfer of basis from my old property to my new property. So I sell a property worth $1 million with basis of $250,000. I reinvest in another property for $1 million. My basis in that new property gets transferred from my old property. It's still the $250,000. And in that way, if I resell the replacement property, that gain is still there. That $750,000 of gain is still there. So please go to the next slide. So why might somebody consider a Section 1031 exchange of their property? And the first bullet point says, if I'm thinking about this with a client, that they may face substantial tax consequences at a sale as they are in a high tax bracket. Well, the current long-term capital gains rate, the highest long-term capital gains rate from a federal standpoint, is 20%. A lot of people also pay on that gain a net investment income tax or the Medicare surtax of an additional 3.8%. So oftentimes on a federal level, when we're looking at the sale of business or investment property, we're looking at a tax rate of about 23.8%. When you add in state taxes, depending on where you live, if you have state income taxes or if the property is located in a state with an income tax, you might pay an extra 3, 5, or more percent of tax, depending on which state that is. So we'll just call it around 30% tax. The second point points out that if I do a 1031, I can leverage the dollars that I would have paid in tax to be part of the value of my new investment. And so in my example where I said I'm selling my property for $1 million and my basis is $250, if I'm paying tax, almost 30% tax on that $750,000 of gain, if my math is right, I'm paying over $200,000 of tax. And now I don't have $1 million to reinvest in property. I would have less than $800,000 to reinvest in property. In the alternative, if I did a 1031 or a like-kind exchange, I could reinvest the entire $1 million of proceeds from the sale of my initial property because I'm deferring that tax. I can buy more. I can hopefully get a better return. And that's what point 3 says. There's an opportunity potentially to transfer some non-income producing property into income producing property because the types of property that are eligible for a 1031 include property used in a trade or business or held for investment. And I've got some more slides to talk about what is or isn't qualified property, but if I have an investment property that I'm sitting on and is generating no income for me, I could potentially sell that property, not have to recognize gain, and acquire property that may create a return for me through rent or other things. 4, we see this used in estate planning under the current estate tax laws, under the current laws. If you die with something, it gets your basis gets stepped up to its date of death value. So going back to my same example, if I have property that's worth $1 million today, and my basis in it is $250,000, and I die, whoever inherits that property would get a step up in basis from the $250,000 to the $1 million fair market value today. And in that way, they would avoid ever paying tax on that $750,000 of gain. Now, the $1 million may be subject to an estate tax, it may not, but those are the current rules. And so using a 1031, you can, under the current laws, you can potentially never pay tax on that unrecognized gain. And the last point there, diversify and reduce real estate and portfolio risk. That's some of the stuff Tom's going to talk about with you a little bit later. So the next slide, please. So this slide goes over some of the property that is available for 1031 exchanges. I said this is anything that's held for investment or used in a trade or business. That would include raw land or farmland. You could exchange that for improved real estate. The rules are somewhat relaxed on what qualifies as replacement property versus the exchange property, so long as they're either held for investment or used in a trade or business. Rental homes, condos, and apartments. Oil and gas interests can qualify if they're real property under the state law. They would qualify. Commercial office buildings. DST stands for Delaware Statutory Trust Interest. That's something Tom's going to talk about a little bit later. Industrial properties, retail properties, tenants in common interests, water or air or mineral rights, if those are considered real property in your state, those can all potentially be part of a 1031 exchange. Next slide, please. This slide illustrates some things that are excluded from 1031 exchanges. And so earlier I read to you the actual code section of 1031, and included in that was the exchange of real property. Prior to the Tax Cuts and Jobs Act in 2017, the real property part, the real, wasn't in that definition. You could do a like-kind exchange of personal property prior to the Tax Cuts and Jobs Act. That went away. Typically in our practice, where we would see that was businesses that would be turning in equipment and trucks and vehicles. You've got a truck in your business and you need a new one. You go to the dealership and you trade in your old truck. They give you something for it as a credit against your new truck. That trade-in was not a recognized tax event because you were exchanging it for something of a like kind. That went away with the Tax Cuts and Jobs Act for personal property, for anything that wasn't real property. We're not here to talk about depreciation today, but there was also 100% bonus depreciation rules that came into play under the Tax Cuts and Jobs Act to kind of eliminate the detriment of losing that benefit on trade-ins of business vehicles. But where we sit today, only real property is eligible for a 1031, not personal property. Stock in trade or other property held primarily for sale, that's inventory. You can't 1031 or like-kind exchange inventory. Stocks, bonds, or notes, unfortunately, Tom and the HBKS folks can't defer your gains when they sell your appreciated stock by buying more stock. Those are recognized. Other securities or evidence of indebtedness or interest. Interest in partnerships cannot be like-kind exchanged. Certificates of trust or beneficial interest. And so those are some of the examples of things that come up, but another way to look at it is it's just real property. Next slide, please. So let's go over some of the basic rules of the 1031s, and then I'll give you some examples before I turn this over to Tom. And so property being sold and acquired must both be held for investment, i.e. appreciation in value, rental income, or business use, and primary residences cannot be exchanged via 1031. And so that's something that comes up a lot. It's just real property. Another way to look at this, what isn't held for investment or used in a trade or business? Something that's used personally. So your personal residence isn't going to qualify for a 1031 exchange. The second point, and this is really important, probably the most important thing as far as the steps for qualifying for a Section 1031 exchange. The taxpayer and property owner must use the services of a qualified intermediary, qualified trust or qualified escrow account. And the only exception is in a true property swap. So let me give you an example of this. Historically, and going back, a like-kind exchange was available. This deferral of gain was available if you were giving up property and somebody was directly returning to you a property of their own. And so in my example before, I said I've got a property worth $1 million with basis of $250. If Tom has property that's worth $1 million, I could give him my real estate and he could give me his real estate, and that would qualify as a 1031 for me. and I can defer the gain. Might qualify, Tom might be eligible for that as well, depending on the use of that property to him. And historically, that's what you needed to do to have a like-kind exchange. The reality is that happens almost never, right? The more likely scenario is that Tom has property worth $1 million, and I want to buy it from Tom, but Tom wants my cash. He doesn't want my property. And so this is where the qualified intermediary comes in, or a three-party exchange, they call it. I sell my property to Tom. I'm going to buy Tom's property, but I hire a qualified intermediary to sit in between that transaction for Tom and I. So I would transfer the rights of the property essentially to the qualified intermediary to complete that sale of my property to whomever I'm selling it to. It doesn't have to be Tom. I'm selling it to anybody in the world who wants to buy my property. I want to buy, but it's not Tom. I want to buy Tom's property for $1 million. The qualified intermediary takes my property, sells it to one party, gets the cash from that sale, and then uses it to acquire Tom's property, and then delivers that property back to me. So what did this look like to me? I gave up property to a qualified intermediary who returned like-kind property to me. That's what is needed for this to work. I hope I didn't sound too complicated, because it's really not. It's really not. And it's not too expensive. The qualified intermediaries that we recommend, I think, are very reasonable in this space. And they make this a very simple process for you. And so for the seller, it doesn't feel a whole lot different than selling property and turnarounding and buying other property. You're just using a QI to do this. And the third point ties into this. It's so important. The taxpayer who wants to accomplish this 1031 or like-kind exchange can never touch the cash. The qualified intermediary is who gets the cash. If the qualified intermediary isn't in place prior to the transaction, you're going to be disqualified from doing a 1031. We can't unravel this, because if you receive cash at any point in this deal, you didn't receive like-kind property, and that's going to affect the entire deal and disqualify the entire deal. Next slide, please. The taxpayer and the property owner must enter into an exchange agreement on or before the date of the transfer of the property. That ties into what I was just talking about. You need to have this in place before you sell the property, before the closing date. The taxpayer must identify in writing the potential property or properties that may be purchased with the proceeds from the sale. And that identification must occur within 45 days of the close of the sale. The general rule, and we'll talk about some exceptions to that general rule, is that you can only list 3 potential replacement properties. So what does this mean? Within 45 days, I've hired a qualified intermediary to close on the property. I sell my property, I close on the property. Within 45 days of the close of the sale, I need to identify to that qualified intermediary up to 3 properties that we may use as replacement property in this transaction. Next slide, please. That indication to the qualified intermediary has to be in writing. That's what 6 is saying. And what 7 is saying is the next important timeline, part of the timeline. I've got 45 days from the close to identify the potential properties. And then I have 180 days from the close to complete that purchase transaction. So that replacement property actually has to be acquired by the qualified intermediary within 180 days of the original close of the property. Next slide, please. This is the exception to that 3 property rule. We see this from time to time. Again, 3 properties is generally the max. However, if the value of those replacement properties does not exceed 200% of the value of the relinquished property, the exchange property, you can identify as many as you want. There's a second exception called the 95% exception that says you can still qualify if 95% of the value of all properties identified are eventually acquired. So if you identify more than 3, but you end up buying 95% of the total value of those 3, you wouldn't run into any issues either. Next slide, please. Again, those identifications must be in writing, must be given to the QI on or before 45 days. It must be generally signed. Next slide, please. Okay, well, let's talk about a little bit more complicated issue that comes up with 1031s, and then we'll get into the examples, and I think that'll make it a little bit more clear. Anything that a taxpayer receives in an exchange that is not like-kind property to the property in an exchange is considered boot. And the taxpayer will be taxed on any boot received up to the total amount of the gain. So if I choose replacement property of lesser value than the property that I sold, the difference is going to be taxable up to the entire gain. Again, I've got examples of this that I think make it a little bit more clear. Next slide. The area where we see boot become an issue as well is that the presence of a mortgage is allowable on either side of the exchange. However, if we don't replace that mortgage, that can be considered boot and can trigger a gain. And again, I have examples of that I think make that a little bit more clear for you. So let's go to those examples now. The first couple examples are just your more straightforward 1031. Here's the opportunity with a like-kind exchange. If I have an existing property with a fair market value of $1 million in basis, or what I paid for it, of $500,000, and I sell that property, my realized gain is $500,000. So there's two different terms on this page. There's realized gain and there's recognized gain, and those are tax terms. And the recognized gain is what I'm more concerned with because that's what I actually pay tax on. But in this case, my realized gain is $500,000 if I exchange this property. I only have to recognize gain to the extent that I take boot from the deal. So in this example, it says that my replacement property, what I'm buying to replace my sold property, has a fair market value of $500,000. I'm only paying $500,000. That means that I pocketed $500,000. And the way the boot rules work is that I will have to recognize and pay tax on the lesser of the boot or the realized gain. And in this case, my realized gain is $500,000 and my boot's $500,000. So I'm paying tax on the full $500,000. Now, said another way, there was no benefit to me doing the 1031 in this case. It's okay that I did it. It's absolutely okay that I wanted to buy replacement property worth $500,000. I just got no tax benefit out of this deal. If I sold it and kept the cash, I would have paid tax on $500,000. I sold it and reinvested $500,000. I'm still paying tax on the $500,000. Let's look at a slightly different example next with that same replacement property, but a little bit of a different fact with the existing property. So now I'm saying the value of the property that I hold today is still worth $1 million, but now my basis is only zero. I either inherited it with zero value, I don't know how I got it with zero value, or it's something that I used in a trade or business and depreciated down to $0. And so my basis now is $0. If I sell that property, my realized gain is going to be $1 million instead of the 500 in the prior example. Now in this case, I'm buying the exact same replacement property with a fair market value of $500,000 and boot received of $500,000. So I'm pocketing $500,000 and I'm reinvesting $500,000. And in this case, again, I'm recognizing the same amount of gain. You recognize gain up to for the amount of cash you pocket, the lesser of the amount of cash you pocket versus the realized gain. I don't have to recognize the full million. I'm only recognizing $500,000 of what I put in my pocket. So the same amount of gain from the last example, except in this case, maybe it did make tax sense to do this transaction because I still got to defer $500,000 of gain. Now let's look at a couple of examples with mortgages. And this gets confused, so I just wanted to try to do some simple examples, the most simple I could, when there's debt on the property, as there often is. So in this case, again, I've got the same fair market value of my building of $1 million, and I've got the same basis of $500,000. But this time I'm injecting the fact that I have a mortgage on that property of $250,000. That doesn't play into the recognition, the calculation of my realized gain on the sale. It's worth $1 million. I have basis of $500,000. If I sell it, I'm going to recognize gain of $500,000. However, when I look at the replacement property facts here, now I'm saying I'm only replacing $750,000 of value. Now, why did I say that? Well, I know what the settlement statement's going to look like when I sell my existing property. I'm not getting $1 million that day. I'm getting $750,000 that day because my mortgage is going to get paid off at the time of settlement. And so that instead of me taking home that full $1 million, I'm going to get $750,000, the $1 million less the mortgage payoff. And so in these facts, I'm saying, well, I'm taking all the cash that I got. I didn't get any extra. There's no extra cash in this deal to me, and I'm replacing it. I'm buying property worth $750,000. Well, that doesn't work to fully defer the gain. That $250,000 of mortgage that I got paid off is considered boot, and I'm going to recognize gain for $250,000, which, by the way, is also the difference between the fair market value of what I gave up and the fair market value of what I replaced it with. So let's look at the next example for how I could have avoided that gain. Existing property, exactly the same facts. Worth $1 million, basis of $500,000, mortgage of $250,000. If I sell it, my gain is going to be $500,000. In this example, instead of taking the $750,000 that I got in closing and buying replacement property, I'm adding an extra $250,000 to the deal to get a replacement property of the same value of what I sold, that same $1 million. And I can do that a couple ways. I can bring more cash to the table. I can bring to an extra $250,000 from other places into this deal to buy that $1 million property, or I could take out a mortgage on the new property of $250,000 to get to that same replacement value. And if I do that, if the fair market value of what I sold is equal to what I invest in the fair market value of my replacement property, then I'll recognize zero gain in this deal instead of the $250,000 that I recognized in the prior deal. So again, debt can make things a little bit more confusing. I tried to give the most clear examples that I could. And don't think that you're limited to that $1 million either. You could buy replacement property worth far in excess of the existing property and still defer the entire amount of the gain. You're not capped at that amount of investment. But that's all I have today for the examples, and I'm going to turn it over to Tom. And of course, if you have any questions, we'll be here to answer those as well.
Awesome. Thank you, Ben. When I think about everything Ben just shared and how it applies to what I'm about to cover, I hope a takeaway that all of you have is that the accounting behind a 1031 exchange is rarely straightforward. So if you have a property that you're considering going down this road of a 1031, whether you're on the buying side, the selling side, wherever you are in that transaction, I really advocate that you have your CPA involved right from the start. If it's an HBK CPA, I know internally we're kind of mandating that TAG gets involved, which is Ben's group that he helps lead. If you have an external CPA, we do have resources here that can help them if they have any questions. So the transaction can be complicated, so hopefully that's one key takeaway. Another important thing that I just wanted to reemphasize is the use of a qualified intermediary. It's vital. It's not optional. We have a great relationship with an absolute expert in this space who's based in Cincinnati, Ohio. Before you, again, go down this road, A, make sure you're incorporating your CPA, and B, please be sure to ask us if you don't have an intermediary that you'd like to work with that you know of offhand. We would really like to facilitate that conversation for you. It's a relatively simple but just absolutely vital piece of this whole thing. So now, when I think about typically over my career, and a client, I have clients, of course, very frequently wanting to sell a piece of real estate associated with their business or a piece of investment real estate that they've owned to try to earn a return. And typically I'll say, well, or over the course of my career, I've said, well, are you going to exchange it? Or I might say, are you going to 1031 the property? I might have to explain what that means. But very, very typically the answer is no, because they don't have another property ready to purchase for that like-kind exchange. And so this is something that's come up very, very frequently over my career. In the last couple of years, however, the idea of utilizing securitized real estate to facilitate these transactions in light of the fact that a replacement property might not be readily available has really gained popularity. And it's become a big part of our clients' lives, and it's something that it's almost no day can go by that we don't talk about it. So I want to give an introduction to that concept here over the next, let's see here, 15 minutes or so before we open it up for some questions. So today particularly, we're going to talk about Delaware statutory trusts, which are known as DSTs for short. DSTs are the most common form of securitized real estate. There are a few others, but as it pertains to a 1031, they're really what is utilized. And it gives investors an opportunity to own fractional shares of real estate that still qualify for a 1031 exchange. One example, as I started exploring this space in a lot more detail a few years ago, there was a warehouse in Las Vegas, and the tenant is Amazon. Some of you might have heard of them. And it was a $100 million warehouse project with a very good tenant. And most of our clients are unable to purchase $100 million pieces of real estate. But through this Delaware Statutory Trust or DST process, investors could own as little as a $100,000 interest in that building. So that's just one really simple example that's easy to understand. Now, DSTs are available only to accredited investors. The rules for what an accredited investor are really complicated, but most commonly it's an individual with a net worth of $1 million or more, excluding their primary residence. There are also some income rules. So an individual who's earned $200,000 of income in any previous 2 years with the expectation that they're going to earn that again this year, or yet higher thresholds for a married couple, and many, many more rules. So there's rules that apply to entities and so forth. So you must be an accredited investor. This is considered a sophisticated investment structure, and so these rules, those accredited investor rules, apply. It's amazing. These have actually been, I guess, made legal as far back as 2004. Like I mentioned, though, it's really just been the last couple of years that they've gained wide acceptance, and they're something that seems to be gaining a lot of traction in our client lives. It's a limited purpose entity. It's really designed to own one single piece of real property or a group of pieces of real property that are related. So if we could do the next slide. There's a number of advantages to DST investing. One, it's very, very simple, and it's very, very low hassle. you don't have to make management decisions. When the toilet clogs, you don't get a phone call that you have to fix it. You don't need to collect rent. You don't need to pay property tax. It's a very, very easy way of owning real estate. You also can invest using lower dollar amounts. So most DST investments allow investments as low as $100,000. Some are a little higher, some are a little lower, but $100,000 is very, very typical. Like I said, most people can't buy that warehouse to lease it to Amazon, but many of our clients can buy a share of that to participate in an investment like that. All debt negotiation is at the entity level, so there's no credit checks, there's no applications for mortgages or anything like that that you might face when buying a property outright. All bank financing is done at the DST level. All property management decisions, as I mentioned, are outsourced. These are professional real estate management companies. Most focus in different niches within this space. So if you buy into a multifamily housing project, the sponsor / real estate management company specializes in that space. Ownership is 100% passive. 1031 tax deferral excuse me, can continue forever. So at the point that a DST property is sold, you can then 1031 those proceeds into another DST or into real property that you identify. So maybe an apartment building down the block is for sale at the right moment that a DST is sold, and you can actually 1031 back into real property and not just a continual deferral into into DSTs. As Ben mentioned, as the tax law is currently written, and I know there's some changes that could be happening there, this tax deferral can continue indefinitely, theoretically to the death of the owner, at which point there would be a step up in tax basis. So the ability to defer gain on real property sale indefinitely or forever, as the law is currently structured, is available. All right, next slide, please. Of course, there are disadvantages, otherwise everyone would be doing it. There is very limited liquidity in these funds. So the decision of when to sell the property is made solely at the discretion of the property manager or sponsor. That typically is 5 to 7 years after purchase. But again, it is really the number one disadvantage of this structure. If these are funds that you believe you would need in less time than 5 to 7 years, this is probably not the right structure for you. You don't have any voting rights and management decisions. As I mentioned earlier, it is 100% passive. And some of these aren't super important. I don't want to, you know what, you guys can kind of see the rest of those. I don't want to belabor those points here. So if we could do the next slide. So again, the DST sponsor, this is important. They're typically, in any one that we would advocate using, are very, very experienced real estate management and development companies. They are absolute experts in the areas that they work in. There's companies that specialize in parking garages. There's companies that specialize in warehousing, commercial space, multifamily space. So these folks know their way around the space that they're managing. You know, they make all decisions related to managing the property. Most importantly is the negotiation and timing of a property sale. That again is up to their discretion. Their motivation, of course, is aligned with yours. They want the investment to pay off as handsomely as possible. Lots of well-known folks in this space. A few that you guys might have heard of, most notably would be Cantor Fitzgerald and JLL, two very, very large folks in this space. Those two companies happen to work in other areas as well, but there's a few examples there for you guys to review. Next slide, please. Almost all DST funds are arranged with 10 years of bank financing. So the goal is always to sell before that 10-year mark. It's very, very typical that they're sold within 5 to 7 years. And in the vast, vast, vast majority of cases, they're sold before that 10-year mark. And again, you can continue to defer the sale of a DST property via 1031 exchange, or you can take the cash and realize the gain at that time. And kind of more review there. Next slide, please. Here's an example of a previously available DST. So the sponsor, as you'll note, is Blue Rock Value Exchange. This is a company that specializes primarily in multifamily housing. This is located in the greater Houston metropolitan area. You'll notice that it's subscribed. They offered $30.6 million of equity. The minimum investment via 1031 is $100,000. Next slide, please. There's some, these sponsors, they kind of make an investment case for the different properties, about the greater metropolitan Houston area, employers located nearby, ability to grow rent, all those factors that might help you decide that this is a property you'd be interested in investing in. One more, please. You'll notice that on this slide, so the equity offering is $30.6 million. The debt is $37.5 million. So the actual purchase price of these properties was $68 million. 55% loan to capitalization, 10-year term, 3.05% fixed interest rate. Most importantly, the cash on cash return would be 4.25%. So if you put in $1 million, the expected payout is $42,500 of rent. That is taxable income to you, offset by the depreciation of the property. So it's really important to understand that all DST properties pay out cash flow on a monthly basis. So these can be, we've had one example, just using an example that we saw recently of a client who owned undeveloped land. They've had a very, very low basis in this land. Due to growth in the area, they were made an unsolicited offer that they really couldn't believe, and it was going to involve a gain of around $750,000 on this undeveloped land. That land was really a cash drag on their finances because of property taxes and insurance. So they're in the process of going through a 1031 exchange. Now they are buying a fractional ownership in property that is now creating cash flow and is a net positive for them on a month-to-month basis. It's of particular interest for them because they're transitioning to retirement right now. Let's do the next slide. I don't want to spend a lot of time on this concept, and I want to open things up to questions here in a moment. One other type of exchange is a 721 exchange, which is also known as an UPREIT. Essentially, what happens in this type of scenario is at the point that you would sell your property, you would do a 1031 exchange into another property identified by a REIT manager. And then after 2 years, in a process called a 721 exchange, that property is absorbed by a REIT mutual fund. The advantage of going through this process is that rather than owning a fractional share in one or just a handful of properties via a DST fund, you gain a diversified portfolio of real estate. So one fund that we have advocated and used owns almost 100 different properties. So when you go through that 721 exchange, it's really considered a measure of safety for your investment. The biggest downside to the 721 process is that at the point that you go through that exchange, you're only deferring your capital gains as long as you own that REIT. So at the point that you were to sell any share, you would realize capital gains. But also you can never take your share in that REIT fund and exchange it into any other property or into any other fund and maintain the capital gain deferral. So once you're in that REIT, you're really kind of stuck there from a tax perspective. That works for some folks. Our experience has been that most clients, however, want to own a fractional share of a concrete piece of property and really kind of have their hands around what it is that they own and have a little more control over their long-term tax consequence of what they own. This is a fund. This is actually from the JLL Fund that we have advocated. And it just shows a few of the properties that are owned: apartment buildings, parking garages, industrial, office space. So it does provide geographical as well as property type diversification. Next slide, please. Why have folks wanted to buy a DST? They want to retire from being a landlord. I know I own some rental real estate. I am the property manager of one of them, and I have great tenants. They've been there a long time, but about once per year I get a phone call and I look at the caller ID and I dread the phone call because I know it's going to cause me a headache. It's going to cost me money. So a lot of folks are done with that process. Again, diversification. You get a new depreciation schedule. So you might have a property you've depreciated all the way and are no longer getting a tax benefit from that. This restarts that process. Again, gaining income, especially if you have property that's not generating income for you now. You can upgrade the quality or the age of the real estate that you own. And one really important thing is current elevated real estate prices. So right now, everybody understands real estate prices are sky high. And a lot of clients are getting unsolicited offers for their properties. I know I do with the rental properties I have. I get phone calls all the time with people wanting to buy them. So it's a way of taking advantage of those currently high prices, but not causing a tax problem on the other side. And another thing that we've heard a lot of is folks that own properties in high tax states or in states that aren't growing quickly and the ability to relocate those to Texas or other places that are growing at a rapid rate. Next slide, please. A couple other quick things. It's prepackaged. Due diligence and financing are already complete. You can save a failing exchange. So if you have a property lined up that you'd like to buy as a 1031 exchange and that sale or that purchase falls through, you actually on the 45th day can identify a DST fund and save the 1031 exchange. If there's any boot, this can help. And you can also use these as a backup plan for an exchange, again, in case it goes bad. Next slide, please. Why would you consider using HBKS for this process? The full resources of over 600 professionals, extensive experience with guiding clients through this process, the holistic perspective that we bring to each scenario. This is not a one-size-fits-all. It's a one-size-fits-one process. We have lots of help with the due diligence on these things coming from Charles Schwab, Wentworth Management Services, and Persh Kaplan Sterling. Everybody's heard of Charles Schwab. The other two folks are really intimately involved in our due diligence process when we advocate for these properties. And again, an established relationship with an absolute top qualified intermediary. So if this is something that is interesting or needed in your financial life, we think we're as good a partner as any to go down this road with. Next slide. Handsome Tom and Ben here. So we have just a few minutes. We covered an awful lot of territory. Ben did a 101 level lesson on 1031s, and I think I did even less than a 101 lesson on the DST funds. So we covered a ton of territory. If you have questions, this would be a great time to submit them.
Tom, we alluded to this a couple times. I wanted to sneak this in before we get off. The Biden tax plan that has come out over the last couple months calls for the elimination of 1031 exchanges for gain in excess of $500,000. So there's been some talk about the elimination potentially of the 1031 exchange for certain folks with gain in excess of $500,000. That's one of the reasons why we're seeing more interest in these transactions. That ties in with the hot real estate market and the situations Tom was talking about, where people are getting offers that they never thought they'd see on certain real estate. The other things included in the Biden tax plan that makes selling property and 1031ing exciting right now is that the capital gains rate I talked about, that's at 20% right now for individuals with income in excess of $1 million. His plan, of course, we're way in the early stages of any of this. None of this is law yet, and certainly not guaranteed to become law. But his plan would increase the tax rate on capital gains for individuals with income in excess of $1 million to the ordinary tax rate, which he would like to see return to 39.6% from its highest rate right now, 37%. So the capital gains rate could double for certain individuals if that law was to be enacted. And finally, in his plan, something we talked about was the estate planning element of this. He talks about, or his plan would include not an elimination of the step up, but a taxing of the unrealized built-in gain of property upon somebody's death. So for individuals with built-in gains on their property in excess of certain amounts, that amount would be taxed. You would get that step up, but you would have paid for it through paying tax. So I know that was a lot at the end there on what's going on or could happen with the Biden tax plan, but that's just something else that's out there that's creating so much interest in these 1031s right now. So sorry for stealing that time on the questions, but we'll take any now if there are.
Yes, I'll sneak in a couple before we wrap up. And if we don't answer your question today, someone will follow up with you via email. So here's one we got in. Do I understand that a partnership formed to hold a real estate, specifically a single building, cannot use a 1031 exemption?
So great question. And we get these issues a lot with real estate that's held in an entity. The entity itself, and in this case, the question, the partnership itself can absolutely do a 1031 exchange. The partnership can sell that real estate. The partnership can use a qualified intermediary and acquire replacement property and absolutely qualify for a 1031. Things get a little bit more complicated when you have some owners who want to do a 1031 and some who do not. There can be ways to work around that. Or you can get stuck. And so a sale of the partnership interest will not qualify for a 1031. But if the partnership sells its real estate, that can qualify for a 1031. And absolutely, my contact's right there if that didn't fully answer the question.
Okay, I'm going to have one more and then we'll wrap up for today. Do you act as QIs or brokers for DSTs or RIAs?
Yeah, I'll take that one. So we do not serve as qualified intermediaries. So that is something that's completely outsourced to those specialists. In terms of with the DSTs, so we have the capacity to serve in multiple roles. So there are structures that enable us to serve as an investment advisor on a DST fund as a registered investment advisor, and then through partnerships that we have, we can help facilitate DST fund investment as a broker dealer or through our partners as a broker dealer. So depending on the need of the client, which really dictates everything, we can fulfill those needs either way.
Okay, that's it, Tom.
Perfect. Well, we appreciate everybody participating, and please don't hesitate to give Ben or I a call or an email, and enjoy the rest of your day.